Yeah, SVB Financial is really interesting because it's kind of a byproduct of what you just talked about, the triangle of doom. So we still have very high inflation, and that high inflation is slowing down the economy. Now, to fight the high inflation, the Federal Reserve Bank is working to raise interest rates. Now, higher interest rates help to cool down inflation, but that also slows down the economy. Now, the case of SVB Financial, the bank, is really interesting because they have been lending money to a lot of startups, like Silicon Valley startups. And when you have low interest rates, it creates ease of access to money. Because like if you can borrow money for 2%, I mean, you only need a 4 or 5% return on your money to justify making an investment. But if you have to borrow money at 10%, now you need a much higher return on your money to justify that investment. And what we've been seeing, and this is not just SVB, I mean, there's a lot of examples of this, but what we've been seeing happen is investment institutions, venture capital firms, angel firms, and startups had such easy access to money. I mean, of course, we printed trillions and trillions of dollars over the last number of years, but now if you wanted to raise money, venture capital firms are sitting on boatloads of cash, and they're competing against each other to get the best investments. And so we saw the valuations of everything rise. Obviously, we saw home prices skyrocket over the last couple of years. The stock market skyrocketed, even though we were going through the worst recession during the pandemic since like the Great Depression. The stock market grew, real estate prices grew, startup valuations went through the roof. And the reason why these valuations went through the roof is because now every bank, every investment institution is competing against each other with boatloads of cash trying to get into these firms. Now, SVB financially, like I'm gonna be completely honest, like this is happening right now. So I only know based off of the information that has come out over the last number of days. So I'm giving you just based off of this. Things can change by the time this goes live. But they were lending money to a lot of startups. I think it was like 4 or 5 out of 10 of the startups out of Silicon Valley had money from SVB. And so now when you're competing against a startup, you might say, okay, if you make $100,000 a year, I'll value you at $1 million. I'll give you $100,000 for 10% of your company, something along that. They'll value it at that. But then if you go to bank number 2 and say, what will you do? And if bank number 2 says, I'll value you at 800,000, you're going to say, well, I'm already valued at $1 million. Can you do any better? Now, bank number 2 might say, okay, I value you at 1.5 million based off your $100,000 of income. Then you go to bank number 3 and say, hey, can you do better? And they might say, I'll value you based off your $100,000 of income at $4 million. Now you're like, okay, we're talking. And now you start to shop like this, and valuations just started to skyrocket. And then, when you have easy access to money, it fuels, I don't want to say it in a bad way, but dumb investments. Because I can pay, if you can get such easy access to money, you can run a business where you're spending $1 to make 50 cents. And this is a tough concept to understand, but a lot of companies actually do this, especially in the early stages where they spend $1 to make 50 cents because they're just trying to grow their market share. They're trying to grow the number of users they had. Like Uber used to lose money on every single ride. Why? Because they wanted to eliminate the competition and get the market share, and they could get the cheap capital. Interest rates are a huge part, because what's been happening now is the Federal Reserve Bank is trying to bring down inflation, because inflation is still, even today, extremely high. We're closer to a peak of inflation than our lows, which means people's incomes are essentially shrinking. Even though, like what we've been seeing happen is people's incomes are rising, but they're not rising fast enough to keep up with inflation. So people are effectively becoming poorer across the country because the cost of living is going down. But now interest rates are going up very quickly. And so when interest rates go up, that means now the investment institutions, the banks, they need a bigger rate of return, because most debt, besides your mortgage, is not a fixed rate debt. It's variable interest rate debt. Most of our national debt, most of our corporate debt, and most of our non-household debt is variable interest rate debt. So when interest rates go up, the cost of servicing that debt goes up. So now you have something like SVB Financial. And I'm not going to go too deep into what they do, but I'll talk about just general, because I don't know too much about their particular financial situation yet. But what most companies do is now they have this boatload of debt, and the debt rate readjusts. And so now when you're investing in companies, your companies have to produce a return in order to continue making the payments on your debt. Well, what we've been seeing across the board, the reason why we've been seeing so many layoffs, the tech sector, is now interest rates have gone up, meaning the cost of these corporations' debts have gone up, and now you need to make more money to service the cost of those debts. And if you have a high debt payment, now you have to figure out, how am I going to have more money to pay down this debt? Well, you can either make more money or cut my expenses. Making more money is hard in a time where inflation's high, people don't have the ability to spend. So what's the alternative? I cut my expenses. I start laying off employees. I cut my expenses. And so now I have money to pay down my debt. Now, that works if you're Meta, Facebook, or Google, but what about the smaller companies that are still in the early stages? Now, your valuation, I mean, you've seen so many companies go from like $1 billion valuation to 200 million overnight. Like, you're talking about, that's an 80% drop. And so now you have banks that show on their balance sheet. Your balance sheet essentially is your net worth statement. So if a bank says, I'm invested in 10 companies, each one of these companies is worth $1 billion, that means I have $10 billion worth of assets. And so now if you take this $10 billion worth of assets and go to get money, you might be able to get, let's just say, an 80% loan to value, right? $8 billion worth of loans that you can then go lend out. But now, when you see interest rates go up, the valuations of these things go down. That's why we've been seeing tech stocks crash. Well, now if your 10 portfolio companies are worth $1 billion each and they fall by 50%, now you go from a $10 billion valuation on your balance sheet to $5 billion.
If they had longer runway, they might not have gotten caught out. But this is Warren Buffett's old phrase, when the tide goes out, you see who's swimming naked.
Exactly. And that's exactly what's going on. Rising interest rates is going to make money more expensive. And that's where you start to differentiate the dumb money and the smart money. And as we raise interest rates to cool down inflation, it is going to cause economic pain. And that is going to be the tide going out.
So what can the average person take away from this?
I think the most important thing here is you need to get financially educated, and you're going to hear me say that a lot. But the reason why is because anytime we go through this type of shakeup or change in the economy, until it slaps you in the face, everybody will keep saying, what's contained, you don't got to worry about it, everything is fine. And I can give you countless examples. In 2020, we saw it happen. In 2008, in 2008, first there's no housing bubble. There's a housing bubble, but it's contained to housing. And then, oh crap, the whole financial system's on the verge of, collapsing. And look, this is not a political thing. It doesn't matter which side of the political coin that you're on. We're all on the same side of we're trying to become financially wealthy. But the reality is, we have our president saying there's no chance of any economic slowdown, not just this year, but in the coming years. Our Treasury Secretary has been saying the same thing. The Federal Reserve Bank is saying we're going to see a soft landing. Now, let's just look at the numbers to really understand what's going on, because the first issue is really what I call this idea of debt monetization, which is probably one of the most concerning issues. And what debt monetization is, it's how is our government funding its operations, and how is that going to impact the regular person?
Debt monetization as a term, if I understand it correctly, is printing money.
Yes,
right?
It's a basic way to explain it. So essentially, think of it this way. The size of our economy last year was about $25 billion. And over the last couple of years, especially during the pandemic era, we printed with the Federal Reserve Bank around $5 trillion.
Jesus.
So to put that in perspective, about 20% of our every single person had to go to work for a year. Every corporation had to work for a year in order to produce $25 trillion worth of money or wealth. The Federal Reserve Bank was able to print $5 trillion with a push of a few buttons, essentially. So now when you think about that, the question is, why do you and I have to pay taxes if the government and the Fed can just print this money? Well, it's because there's a cost to this money printing. What is that cost? Well, that cost is inflation. And so we're in a situation right now where the amount of money that has been printed is insane. And we don't even know the exact amount of money. Like, we know the stimulus was something around $5 trillion, but the Federal Reserve Bank also did a lot of unlimited quantitative easing. The definition of money changed during 2020, M1.